Hi, my name is Rajiv Rubello, and I'm the principal and actuary of Colva Insurance Services. Colva is a life settlement and life insurance consulting firm that really focuses on advising policy owners on how to get the maximum value out of their policy. Today we're going to be focusing more on the life insurance side, and I'll be speaking about why fiduciaries have a responsibility to review the life insurance policies under their care in a quantitative and comprehensive manner. So let's just go over a quick agenda of what this presentation is going to look like. We'll start off talking about the need for a fiduciary responsibility for these life insurance policies, and we'll start talking about how this need arises specifically because of how these policies are sold, which is by agents representing life insurance carriers and not always acting in the policy owner's best interest. We'll then go over a specific legal case example that shows how a trustee was sued for not taking the proper actions with regards to a life insurance policy or policies rather under their care. This will then tie into the Uniform Prudent Investor Act, which lays out specific protocols that should be followed in order to make sure that a life insurance policy is properly being managed by the trustee or fiduciary. We'll then go over some of the mathematical elements of doing a quantitative review and what that looks like with regards to a specific case. But let's just start off by, talking about my experience and what led me to be talking here on this topic. I started my corporate career as an actuary at New York Life in the mortality division, basically looking at experience studies on the mortality side and the lapse study side, just looking to see if our expectations for mortality and lapsing policies matched our experience. And then we adjusted our data and assumptions going forward. I then moved into the product development side, and where I helped to price the UL and VUL products, basically looking at these products and the design of these products and trying to make them profitable for the life insurance company. Based on this experience, I was recruited to work for AIG, which then became Chartis, which owned and still owns to this day the largest life settlement portfolio in the world. At that time, it had approximately $4 billion worth of life settlements, which was about $18 billion in face, and over 6,000 life insurance policies. In 2011, I started Colva as I realized I wanted to use my skill set to help advise both policy owners in the life settlement and life insurance side on how to get the maximum value out of their policies. So why do life insurance policy owners need a fiduciary in the first place? Well, to start off with, it's because life insurance agents who sell the policy at the start to the policy owner are incentivized to act on behalf of the life insurance carrier and maximize their own commission, as opposed to trying to act in the best interest of the policy owner. Life insurance agents can make as much as 50% to 120% of the first year premium that the client pays into the policy, so obviously they're incentivized to get the client to purchase as much life insurance as possible, and on top of that to pay as much for that policy as possible. However, the downside is that 50% of all permanent policies are canceled within 10 years. And furthermore, when clients cancel, they face a huge cancellation penalty. So what's happening here is that the clients are paying a lot in premiums into the policy because they're advised to do so by the life insurance agent, but then they're canceling it. And when they do, they're faced with a huge cancellation penalty. So what ends up happening is that clients actually end up earning very little on these premiums that they're putting into the policy, even though the life insurance agent is advertising a decent return. When the truth is that the clients are paying premiums into the policy, then canceling it and dying later without getting the death benefit because they already canceled the policy. In truth, a lot of clients could be better served by properly managing the premiums they pay into the policy and investing the difference elsewhere. Another issue that kind of arises is when policies are not funded properly. So what happens is sometimes policies are over or underfunded, and as we'll see in our legal case example, what happens sometimes is that the interest rates at issue of the policy are very high, but over time, economic conditions deteriorate, and so do the interest rates being afforded on the policy. This means that the premiums being paid in the policy are no longer sufficient to keep the policy in force to the life expectancy of the insured. So now let's go ahead and go over a specific case in which a trustee was sued for not fulfilling their specific fiduciary responsibilities with regards to a life insurance policy on behalf of the beneficiaries. So what happened was, in 1999, the family of Stuart Cochran transferred $8 million worth of life insurance policies to KeyBank to manage as a trustee. However, what happened is that in 2003 there was an economic downturn, and KeyBank was notified that the premiums to keep the policy in force would no longer be sufficient. KeyBank realized that monitoring of these policies was outside their scope of expertise and hired an outside consultant to do a review on these $8 million worth of policies. The consultant review found that the $8 million worth of policies would lapse well before the life expectancy of age 88 of the individual. At the time, Stuart Cochran was 52. The consultant recommended that the trustee continue to monitor the policy but not take further action until a later time in which the policy could be re-reviewed and further action could be taken as necessitated. However, a broker convinced KeyBank to exchange the cash surrender value in those $8 million policies for one $2.8 million policy guaranteed to keep the policy in force to age 100. KeyBank decided that this was a necessary transaction in order to mitigate the longevity risks that might occur if they continued to pay premiums on the $8 million worth of policies and it didn't keep any of those policies in force to the life expectancy of the insured. However, there were consequences that came with this action that KeyBank decided to follow through with. The first is, of course, the broker earned significant commissions on the exchange of policies from the $8 million policies to the $2.8 million policy. The second was that the policy owner paid $107,000 worth in surrender charges from the account value of the $8 million policies and converting it to a $2.8 million policy. However, the worst possible consequence was that the insured died soon after. What this means is that the beneficiaries received $2.8 million in death benefit instead of $8 million worth of death benefit if the trustee would have just kept the original policies. However, ultimately, this lawsuit versus KeyBank was thrown out by the court, as the court decided that KeyBank acted prudently but imperfectly. So let's go ahead and break down those two components in discussing this case. The prudent course of action that the court found that KeyBank followed through with was that KeyBank acknowledged its own lack of internal expertise and hired an outside insurance consultant to review the policy and make a recommendation based on his qualified analysis. At the time, the exchange of policies made logical sense, given that KeyBank did not want to take the risk associated with the longevity chance that the insured lived past his life expectancy. The imperfect aspects of KeyBank's decision-making process was that, first and foremost, KeyBank did not have a defined evaluation protocol. On top of that, this protocol was not made known to the beneficiaries, so the beneficiaries had no idea at the point that they transferred the policies into KeyBank's care that KeyBank would even consider exchanging these policies for a lower face amount one. So this brings us into a discussion of the Uniform Prudent Investor Act, or UPIA, which was passed in many states specifically to help fiduciaries manage all their responsibilities with regards to managing the life insurance policies under their care. The first and foremost element of this act is that it mandates fiduciaries treat this insurance policy as they would any other asset under the care of an investment or financial advisor. And that is to use financial metrics such as net present value, internal rates of return, to evaluate future expected performance and risk. Another element of this act is that it asks fiduciaries to evaluate different investment funding strategies for these policies and the benefits and opportunity costs associated with them. For example, it's possible to overfund a policy in the earlier years, such that in the later years, if the insured lives past his life expectancy, the longevity risk is mitigated. However, it's also possible to underfund the policy in the early years in order to maximize expected IRRs, while also accepting the possibility that the insured lives longer than the life expectancy, which would then cause premiums to rise significantly. So these are two different investment strategies that are important for fiduciaries to take into consideration as they evaluate the policy on an ongoing basis. Another element of this act requires fiduciaries to compare this policy to current policies operating in the market or being sold in the market to make sure that the performance is on par, if not better, than those policies currently being sold on the market. Furthermore, the Act allows trustees and fiduciaries to delegate this responsibility to other qualified parties who are more experienced and understand the versatility of these policies on their behalf. So now that we've talked about the importance of implementing the UPIA in management of these policies, why is it important that COLVA be chosen in place of our competitors for doing this type of review? Well, the first and foremost reason is that we have top-of-the-line actuarial and insurance expertise. At COLVA, we've actually priced and helped design some of these products, and so we understand intimately the mechanisms by how they work. If you look at the experience of some of our competitors, you'll find that most of them are life insurance agents or former life insurance agents or salesmen. Here at COLVA, we don't sell life insurance. We provide quantitative reviews of life insurance policies in order to help policy owners maximize their value that they're getting from them. Our opinion is an unbiased one. If you need life insurance, or if we recommend that life insurance be purchased to exchange the policies you currently have, you can take this opinion and purchase life insurance from any other agent of your choice. Furthermore, we provide a detailed report and analysis that shows exactly how this report is meeting each part of the Prudent Investor Act. This allows the client to be comfortable in knowing that his duties with regards to this act were fulfilled. Furthermore, as we mentioned at the beginning, COLVA's expertise is in saving premium costs. We understand that the insured might live 5 years, 10 years, or 25 years, and it's important to understand and fund the policy accordingly. And we can save clients premiums with regards to any funding premium strategy they choose. So now let's go ahead and look at a specific case example and the quantitative review that we would do on this type of policy. The case that we're going to be looking at is a new potential policy of $10 million in face on a 65-year-old male. His life expectancy is 90 years, or 25 years from the point of purchase. The agent is illustrating that the potential client paid $270,000 each year for this $10 million death benefit. And the agent is saying that the policy is crediting a rate of 4.4%. As we'll see later, the policy is earning actually much less than this. So here's a quick chart that's similar to an illustration an agent might show you. The first two columns are the policy year and the age at the end of the policy year in 5-year increments up to age 100. In this third column, which is highlighted in purple, we see the premiums being paid each year, which is $270,000 each year. It's a level premium. In this column here, we have the surrender value at the end of each year. And finally, we have the death benefit at the end of each year. So we can see as the time goes on, up to the life expectancy, which is highlighted in pink, that the surrender value is increasing. And if we just look at it from a distance, we can see that it's accumulating to $10 million at age 100, or the equivalent of the death benefit. And it appears that the premiums that are being paid into the policy are earning a decent and significant return. However, this is a little bit deceptive, as we'll see in the following slides. As it looks here, the premiums being paid each year appear small relative to the end of the year's surrender value. However, if we take that same slide, but we replace the premiums being paid each year with the total premiums paid to date, we see a different story start to emerge. And that is that the surrender value doesn't nearly match up to the total premiums paid to date. So for example, at the end of 5 years, we see that $1.3 million in premiums have been paid, but only $700,000 worth of surrender value remains. Analogously, at the end of 25 years of the life expectancy, nearly $7 million worth of premiums have been paid, but only about $5.6 million worth of surrender value remains. So this is a completely different story than what is initially appeared to be on the illustration. And that brings us to our main point, which is that when we look at the premiums paid to date, it's apparent that they're much larger than the end-of-year surrender value, which implies that the actual returns that being earned on the surrender value are much less than the 4.4% being illustrated. So let's now go ahead and look at the end-of-year IRRs on both the surrender value and the death benefit. Again, we have the first two columns are the policy year and the age at the end of the year. We can see that the surrender value IRRs are negative all the way until the 35th policy year. Furthermore, the death benefit IRR, which is the internal rate of return if the client pays the premiums and then receives the death benefit at the end of the year, is actually quite high until around the life expectancy of 25 years, at which point it drops. In the last column, I've added the probability of survival to the end of the year. So we can see that with a life expectancy at 25 years, there's roughly a 50% chance that the insured lives longer than this, and the return on the death benefit and the surrender value IRR are less than those illustrated here. So as we can clearly see, paying a level premium on most policies results in a very low IRR on the surrender value to the life expectancy of the insured. And as we'll be touching upon in the next slide, it's important to consider the life expectancy of the insured when deciding upon a premium funding strategy. So now let's go ahead and look at an alternative way of funding the policy, which is instead of paying a level premium policy each year of $270,000, what we're going to do is we're going to pay the minimum premium payment each year. However, as we'll see, the minimum premium payment starts off low but starts to get high, and this is instead of paying a level premium that is the same each year. So we can see, for example, in year 5 that the premiums required to be paid in each year is only $52,000, which is significantly less than the $270,000 level premium. However, over time, this premium required in the year increases significantly, such that by year 20, it's $600,000 a year, and by year 30, it's almost $800,000 per year. We can see the end of the year surrender value is also much less. So we're leaving a minimal $1,000 value at the end of surrender value. So there's not much accrual in the IRR, or rather in the surrender value. And the reason we're doing this is because we want to minimize the premiums being paid in the policy while maintaining the $10 million death benefit. So in this slide, the main takeaway is that while the premiums being paid for the minimum funding are low in the early years, they get higher in the later years. So in this example, what we're doing is we're comparing the level premium funding IRRs versus the minimum premium funding IRRs and premium requirements. So we can see in just looking at the level premium side over here that the premiums being paid in the policy to the life expectancy, or 25 years, tend to be higher than the minimum premium requirements to keep the policy in force using this funding strategy. In fact, if we look at year 20, for example, it costs $5.4 million to keep the policy in force using a level premium strategy, but only $4.1 million to keep it in force using the minimum premium funding strategy. We can see that the LE of 25 years, or at age 90, slightly $7.2 million have been paid for the minimum premium, so a little more than 6.75 for the level. However, the IRRs on the death benefit side are higher, and this is because the premiums being paid in the policy are being minimized, and because of the time value of money. So we can see that the corresponding IRRs for the death benefit IRRs are higher up until the life expectancy using the minimum premium funding strategy. After that, we can see that the premiums required to keep the policy in force increase significantly. So if you use the minimum premium funding strategy and the person does happen to live to age 100, you actually end up paying $15 million for this $10 million life insurance policy. And this is why it's important to consider the life expectancy of the insured when determining a funding premium strategy. If, for example, what happens is 5 years later, the insured gets in worse health and has a stroke or heart attack and is only expected to live another 5 years or so, it's important to adjust the premium strategies accordingly, so that the premiums are minimized and the IRR returns are maximized. So the takeaway, the level premium funding strategy reduces longevity risk, while the minimum premium funding strategy increases expected IRRs on the death benefit. So let's just go ahead and recap the main reasons why it's important that ILETs and trustees and fiduciaries review the life insurance policies under their care. The first and foremost reason is that it's very well possible that the policy could be over or underfunded. As we saw in our main case example, a policy could be overfunded if the policy is earning very little in terms of accumulation value, and the policy owner would be better served paying less in premiums and investing that difference elsewhere in another product or investment strategy. The policy could also be underfunded if there have been changes in the cost of insurance charges or the interest rates. So if the cost of insurance has increased or the interest rates have declined, this would result in a new premium being owed on the policy that is much higher than it was originally anticipated. and it's important to account for this accordingly. There could also have been changes in the life expectancy of the insured since the policy was originally purchased and now. For example, if the policy owner was originally expected to live to age 90, but now is only expected to live to age 70, it's important that the premiums are adjusted and lowered accordingly so the policy owner does not end up overpaying for the same death benefit. Also, there could be other products on the market that offer better performance in terms of IRRs, net present value of premiums for the policy owner and their beneficiaries. So it's important to evaluate these other products currently on the market with the current performance of the product that they have and make the appropriate decision. So this concludes our presentation. If you have further questions on our policy review process, please visit our website at www.culverservices.com, or you can give me a call or email me directly at 1-800-561-4028, extension 301, or my email, which is rajiv.rebello@culverservices.com. Thank you.